G'day, Westy here. Okay, today we're going to do some share valuation, and we're going to go through quite a few different ways of getting to work out the value of the company and the value of the share, especially, and the growth expected. So this is quite important, or very important, so pay attention and we'll get on to it. So what we need to do is first of all open up barchart.com. So that's the main page, barchart.com. Then open up another tab and then go to buffettsbooks.com. I'll type it in, buffettsbooks.com, and on the go to the main page. When that comes up, go to Academy and go to calculators. So we're going to go to discounted cash flow calculator and click on that, and that brings up a lesson that is a very, very good lesson to look into. So these guys actually are really pretty switched on cookies, and they happen to have a great DCF calculator in their website, which is provided free of charge for people to use, which is fantastic. They also have I don't have nothing to do with these guys, so I'm not getting any money out of these guys at all, but they do have a really intense training course on exactly how to value a stock. Okay, so first of all we need to find out we're going to do the DCF calculator right through that process first, and then we're going to look at a couple of other things. And I'll go through some really important items that I believe you need to work out. So first of all, what is the company's free cash flow? So that's the estimated average 10 year over the last 10 years free cash flow. So how we find that is we go to barchart.com. We're going to do, in this example, we're going to do a company called Domino's Pizza. So we're going to go to DPZ. DPZ. Sometimes it's case sensitive. Okay, check you got the right one here. So it's Domino's Pizza Inc. Yep. Current price is $278.26. So what we've got to do, we want to find out what the free cash flow is. So go to the cash flow sheet in the financial section down the bottom there. Go right to the bottom and it's got free cash flow here. Go to the bottom one here. So free cash flow is basically all your assets minus all your liabilities, including debts and dividend repayments, and you end up with a surplus cash, and this is what we want to know. So it's called free cash flow. So basically up the top here we've got years 18 down to 14. So I'm going to copy those, the bottom row, free cash flow, from left to right, and that goes from 2018. I've got a spreadsheet set up here which will just capture these numbers here, and then go back to the main page and go right up to the top and click next, and you want to go 2013 to 2009, scroll right down, bottom line, and copy these items here. Go back to your main page and paste it in there, and I've averaged it out. The formula is over 9 years because you can't count year one, so from year 1 to year 2 is year 1, so that's the reference year is the 2009. So we've got 1, 2, 3, 4, 5, 6, 7, 8, 9. So I've done the total sum of those 9 year all of those costs in here, all of that cash flow summary, summed up the whole lot, added them all together, and then divided them by 9, and that's how I came up with an average of $182,497. So don't worry about adding on the extra zeros and stuff, because as you'll see in here, it'll tell you that it's it's in thousands. So all of these values here are in thousands, so you add 3 zeros. But we don't need to do that because it's all in the same relative decimal placing, so you'll see what I mean later. Okay, so now we know what that is. We can copy that calculator and put in that value in there. Short term, in the short term, what percentage annually, use a whole number, do you expect the free cash flow to grow? Now this is quite a tricky one, and this is where I have read quite a few Warren Buffett books. One in particular that I really enjoy and really use. I've got pink tabs coming out the wazoo on the pages, out the sides of the book, at the tops of the book, at the bottom of the book, so I can reference areas really easily. So it's called the new Buffettology, and it's really great. It's written by Mary Buffett and David Clark, and so it's a really good read. And so I've learnt some really important lessons in there, which I'm going to share with you guys today. So how Warren does it is he works out the EPS growth of so the EPS average growth over the last 10 years. So what he does, so basically you need to go to a different sheet for this. It's called the income statement, and you'll see the EPS in here. So I use the EPS diluted continuous ops, which is all the costs out. So basically that's going to be your net earnings per share. So what you do there is you go to you work out what the earnings per share average growth is, or compounding growth. So basically you copy all of these from 2009 to current, all of those, copy all of these ones, and that gives you an EPS total of 9 years, including, because it's the one's the start of year. Back in 2009 is your start year, and then that's year one starts here at 2010, and so forth. So you get that EPS value, and what you do is you work out the average growth of that to calculate the EPS growth over that period of time. Now I'll show you how to do that in a moment. So to get the growth of the company that's been going over the last number of years, what we'll do, go back into Warren Buffett books, go to Academy, and then go to calculators, and then go to intrinsic values. So what we've got to do here, go down to the actual calculator. So we've got to go to current book value. So you're looking at the EPS of the current year. So let's go to it here. 2018 is $8.35. So we're going to put that, the $8.35 in here. Old book value. So we'll go back to the old 2009. And remember when I said before, the first year is not counted, so you go from one to the second to be first. So it's $1.38. So basically this is 9 years, so 1.38. So put in old book value of 1.38. Years between values, 9 years, and calculate. So we've got 22.14% average growth of that particular stock. Okay, so just make sure we make a mental note of that as 22%. So what Warren's saying is, of all your earnings, only 40% of those earnings are retained. So in this case, we've got $8.35, and of that $8.35, we've only got 40% of that left. So if you take 40% off that, so what Warren's actually saying is, if the average compounding EPS growth is say 20% over 10 years, then 40% of that will be approximately retained. So if you take 40% of the 20%, 22% in this case, so 40% of 22 is 8.8%. So if you go do a formula here, times 0.4, so 40%, ends up being 008.8, and you convert that to a percentage and you end up with 8.8%. So that's like a discounted ratio that you use, because you don't actually get to retain all of that, because you would be putting it into R&D, shares or whatever, and you know what I mean. So those sorts of things will yeah, you'd retain about 8.8% of that. So what we want to do is determine the actual estimated future price based on an 8.8% growth, 8.8% factor of compounding average growth, of net compounding average growth, and over a 10-year period, figure out how that actually works. So I'm just going to show you in a calculator how to do that. So what we're going to do is we're going to work out the value in the future based on that 8.8% reduced growth. So the current value of Domino's Pizza is 278.26. So I'm going to show you now, I'm going to cut to it right now and show you how to do that on the calculator. Okay, so we're going to add in 278.26, which is the current value, and press PV for present value. And we're going to put 10 years and then press N, and then we're going to do 8.8 and then put it in percentage I. Press CPT for compute, and then press FV for future value. And we've come up with 646.75. So what this means is that the current the current value of 278.26 in the future will be 646.75. So now let's look at what sort of dollar value you would need to be paying to get the same return as the current treasury bond, investing into a treasury bond. So the current treasury bond, basically you go to the treasury.gov website, chuck in search treasury yield, and it will come up with this page on the first link. And as you can see, as of the 7th of the 5th, the 5th of July 2019, it's got 2.04% 10-year bond yield. Okay, so what we do is, to determine the relative share valuation, we divide the current EPS, which was $8.35, 8.35, and we've got that here in the cash flow statement. Sorry, income statement, and we've got 835. So we take that 835 and we divide that by the current bond rate, which is 2.04%. So you divide that by 0.0204, and that comes out at 409.31. So what this is saying is that if you were to buy a share, one of these shares in Domino's at the moment, for $409.31, you would, based on the current previous 10 years performance, if you were to get a 1% yield, you would pay as much as $409 and expect to get a similar return over that period of time. So I hope that makes sense. So basically, in summary, really, if you have a look at if I go to one of my favorite sites, which is Guru Focus, and put in DPZ in there, DPZ, you can see, I look at this here as well, the volatility rate. Where is it? Volatility ratio is 29%, 29.8%. So currently, its high, 52-week high was 305, and it's currently trading at 278. So it's almost 10% off its last peak. So even at that price, you'd still consider looking at that and go, well, I'm going to make 8.8% return in 10 years' time. I expect that share to be around about $646 per share. So you know, you should make some money there. And you can see here that this is really good thing about this website for Guru Focus is you do have a really good show of the revenue, how the revenue's going, but they do have a lot of debt, these guys, and that's one reason why I wouldn't buy them, because they've got massive amounts of debt. So too high for me. But I just wanted to show you how to calculate based on growth, like EPS. So it's still performing as far as earnings per share goes, but it's got lots of debt. So currently it's got 3 billion in debt, and net is 25 million in cash. So it's not a lot. So anyway, I hope that sheds a little bit of light, and you can play with a few to get some numbers and stuff, and see how that goes. Cool. Right, this is Westy over and out. Thank you. So now let's look at what sort of dollar value you would need to be paying to get the same return as the current treasury bond, investing into a treasury bond. So the current treasury bond, basically you go to the treasury.gov website, chuck in search treasury yield, and it will come up with this page on the first link. And as you can see, as of the 5th of July 2019, it's got 2.04% 10-year bond yield. Okay, so what we do is, to determine the relative share valuation, we divide the current EPS, which was $8.35, 8.35, and we've got that here. So let's just back test this theory. So with Domino's, let's look back in 2009. It had a EPS of 1.38. So we know that the 1.38, we'll get it on the calculator, 1.38. We know that it was the 10 years before that was again the same growth with the same 8.8% growth expected. So we can still use the same yield ratios, etc., etc. So it's EPS was 138. So let's have a look back and see if we can find what the bond was, which I did a bit of research before. Back in 2009, it was 2.86% government bond. So divide that by 0.0286, and we've come up with $48.25 a share. Now back then you paid $8 for that share, so you would expect over that 10 years that it would increase to $48 a share, which is still a really good return on the $8 that you got. Now let's fast forward across to the left here to the current day, and look how much the shares have grown. So we've well and truly exceeded at $8 a share. You know, if you had have bought, say, you know, even $1,000 of shares at $8, you'd be so 1,000 shares at $8 times that 248 by 1,000. That's a big markup. Let's see what that is. So 248, and you bought 1,000 shares times 248,000. But you paid, oops, 1,000 by 8,000. So that $8,000, you go to cash them in, 1,000 shares times 248, that's 248,000. So that's how, by doing those numbers, that yeah. So this is a back test example to see whether that theory actually works, and well and truly exceeds our expectations, and we would have been still making good money if we had have been able to buy it at $48 a share. Sell it at $48 a share. So that same, if we had sold it at the same $1,000 share times 48, that's still 48,000 out of the 8,000 that you had. So that's a real good growth. All right. So yeah. So hopefully this has made a bit of difference, and hopefully you can figure it out. And good luck with your investing. Cheers, Westy, over and out.